Hi there, I'm Jonathan Bayes and this is our March Investment Market Outlook, and we're pleased to have Hayden Scott from PIMCO join us with his thoughts on the world economy. I promised you last month that we would talk a bit about corporate reporting season. For us, it was actually fortunately okay, but across the board I think it was actually a pretty indifferent results season. Several of the consumer-facing companies you'd all be familiar with pointed to a more subdued consumer outlook. I think it's going to deteriorate as we go through 2019, which I'll touch on later, but Coles and Woolworths and Flight Centre all made mention of the softening consumer environment. But within our portfolios, fortunately, a couple of the bad ones bounced back and a couple of our good ones maintained strong momentum. So IOOF has bounced very strongly in the last month. They gave us no reasons for further concern on remediation expenses after the Royal Commission, so that's a positive. I think we'll see that stock back at $7 in the next couple of months before it sort of holds ground. We had some great momentum in Afterpay, which is something you'd all be familiar with as well. They're 3.2 million users now. Profitability was fantastic despite capping late fees, so really 5 stars for Afterpay there. In the case of Amcor and Downer, it seems like what was a pretty rotten year for Amcor on several fronts is now starting to turn, so margins are improving within the business with the fall in chemical costs, and we do have a turnaround in volumes in the North American beverage market, and again emerging market momentum is starting to turn from negative to positive as well. So we're encouraged by that, and the stock's actually doing quite well too. And in the case of Downer, perhaps we were hoping for a bit too much in terms of its economic sensitivity, and so the numbers weren't quite as strong as we like. But across the board, momentum is strong and cash flow is good, and we may just actually see a nice sale of their contract mining business in 2019. So the last month on the economic front globally was mixed again. There are some signs that China is bottoming out, but it's really only early stages, and that stems from policy introduced in the last couple of weeks, a big surge in financing to the economy in January.
So in terms of updates, just in terms of the US, the Federal Reserve last year hiked rates 4 times, so now at an official cash rate of 2.25 to 2.5. And we think, this year's going to look slightly different actually. So 4 hikes last year on the back of some really strong growth numbers. This year we think it's going to be different for the US, and the US Feds, they've signalled as such. So we think that it's going to be either 0 or 1 hike this year, so a lot different. The Feds have said basically we're kind of on hold. So what does that mean? So the US yield curve is now at about 2.65. So roughly what that means is that the forward-looking market expectations for interest rates in the US are 2.65. So pretty low. And the front part, as I mentioned, is that the front part of the yield curve or official cash rate's roughly at sort of 2.25. So that tells you that the yield curve, the 10-year curve, is pretty flat, which really tells you about the health of the US economy. So still in growth mode, so still positively shaped, but looking a lot flatter than what it's been like in the past. So fairly benign growth expectations, fairly benign inflation expectations from here on in. It's probably worth noting as well that our recession forecast has gone up. Certainly still not base case that we enter any kind of recession this year, but the probability has increased. So what are the risks? What are the things that we talk about and that keep us up at night? So there'll be a few that get aired fairly regularly within PIMCO. So the first one is election risk. So there is elections in Europe this year and US next. Geopolitical is always something that features as well, although I think they've tapered off somewhat. The main one, of course, is the US-China trade tensions. So we think that they're very close to getting a resolution now. Certainly the chances have increased that they get a resolution. Tensions have dropped from a boiling point to perhaps a simmering. Fair to say that it's certainly still on the stovetop. It's not within anybody's interest to enter into a trade war, and we think at some point soon they will resolve their differences.
And in Europe, sadly, conditions just continue to worsen. So much so that the ECB, have effectively kicked into the long grass any chance of raising rates, and in fact actually extended their long-term financing to the bank sector only last week as well, to try and kickstart an economy that's really only growing, not much above 1%. We probably have rates globally on pause. The Fed talked about being patient last month, and that's helped share markets to bounce as far as they have. And Australia has actually bounced really pretty strongly in the same light, despite the weakening economy and despite the corporate reporting season that I think was kind of indifferent. So we're now a couple of percent only away from our highs we got back in September. And I do think there's reason for caution globally, but more particularly locally here in Australia. And every other week at the moment, the data seems to come in a little bit weaker than expected. Last week was the service sector data for new orders, which fell away at the fastest rate we've seen in 5 years, and that's led through to today's NAB business conditions numbers, which fell away again. I made mention in some of the weekly notes you may have seen about the fall in employment indicators locally here. ANZ job ads are now running down over 4% year on year, and that leads employment here locally by about 6 months. So I think we've seen a peak in the employment cycle here, and that will probably bring about a further deterioration in consumer confidence. And lo and behold, this morning, here it's 11th or 12th of March, we've had ANZ consumer confidence figures for the week just gone, and they've fallen to near enough to a 3-year low. So we are definitely about to get interest rate cuts. Last week's GDP numbers, where we saw a rise of 0.2% for the December quarter and a rather flattering annual rate of 2.3%, did bring out a few economists prepared to stake their name against rate cuts before the end of the year. I think it's a shoe-in. I think the Reserve Bank are probably holding fire until after the election so that they get the best bang for their buck into a softening consumer post a likely Labor government. So, I really think it's time to be more concerned and cautious with our Aussie equity portfolios, and that's precisely what we're doing within the managed accounts as we speak, and raising cash up to near enough to peak levels. Anyway, hope that's helpful and hope you have a great month.